We've all been there. You get the big raise,
Yeah.
you upgrade the apartment, you finally buy that new car you've been eyeing.
Mm.
And for a few weeks, maybe a few months, you feel, I mean, a genuine shift in happiness. You think, this is it, I've arrived.
Right.
But then it's almost inevitable. The feeling just, it fades. The new car is just transportation. The big salary jump is now just your normal paycheck. Why does that surge of excitement always seem to fade away?
It's probably the single biggest psychological barrier to any kind of lasting financial satisfaction. And it has a name. It's called hedonic adaptation.
Or the hedonic treadmill. I've heard that one.
Exactly. The hedonic treadmill, which is, I think, a much more accurate and visceral description of what it feels like.
Okay, let's unpack this right away because it feels like understanding this is the key to escaping the whole cycle. So hedonic adaptation is what? It's the tendency for us to just go back to our stable baseline level of happiness after something big happens.
That's it. Exactly. Whether it's a big positive event
Right.
or even a big negative one. And evolutionarily, it's brilliant.
How so?
Well, think about it. If you experience a major loss, a profound setback, your ability to adapt, to return to some kind of emotional equilibrium, that's what ensures resilience. It's a survival mechanism.
Right, you don't stay devastated forever, you recover.
But, and this is the big but, when you apply that same mechanism to financial gains, it becomes incredibly destructive.
Destructive because it locks us into this endless, exhausting chase for more money. You hit a goal, you feel good, you adapt to the new circumstances, and that becomes the new normal.
It's the new baseline. And suddenly you feel this compulsion to achieve the next thing just to get that initial feeling of excitement back.
And if you leave that unchecked, you're trapped. You're in a cycle of lifestyle inflation, financial stress, and you're making zero forward progress towards any kind of real wealth.
And that really defines our mission for this deep dive. We're going to get into the specific mental frameworks, the identity shifts, and frankly, the cold, hard math that you need to break this cycle.
We're trying to give you the shortcut here, the right framework, not just, the advice to make more money.
Exactly. And to make sure you catch every insight, make sure you subscribe to Money Mindset and check out the links in the description for the sources we're diving into today. This is all about getting well-informed fast so you can start building real stability, not just funding a bigger list of bills every month.
Okay, so let's start with the most immediate threat to building wealth, the hedonic trap, and how it actually shows up in our day-to-day financial decisions.
So the most visible way the treadmill shows up in our finances is it's a little thing called lifestyle creep.
Ah, yes,
Right.
lifestyle creep.
It's insidious. It's how when your income goes up, your spending just tends to go up right along with it, and often faster than you even realize.
It's almost automatic, isn't it? People upgrade their habits without even thinking. They move from the small apartment to a bigger house that needs more upkeep.
They shift from dining out once a week to 4 times a week, or they finance that luxury car the second the new salary hits their bank account.
And the real killer here is the psychological part of it. The thing that was once a luxury, like eating out a lot, it just morphs into a perceived necessity. It's not an indulgence anymore.
No, it's just how you live.
Yeah.
And that's the core of the problem. Your baseline shifts so fast that you feel like you need the nicer things just to maintain your current level of satisfaction.
And the result is this total illusion of progress, right? You look at your bank account and you feel like you're not making any headway, even if your income has literally doubled in the last few years.
Because your spending has risen right along with it.
Wow.
You're prevented from building any real lasting wealth because the gap between what you make and what you spend, it's still zero or close to it.
Yeah, this is exactly why you see these high-income earners. Doctors, lawyers, executives, who are still completely stressed about money and job security.
They're still on that paycheck-to-paycheck treadmill.
Yeah.
It's just that the paychecks are exponentially larger.
Their speed has increased, but their position hasn't changed at all. They're still in the same place.
And that speed is fueled by what we could call the consumer spending treadmill. This desire for constant novelty. It drives us to buy the latest iPhone, new clothes, expensive home renovations. We're just chasing that momentary chemical hit of getting something new.
And we know this doesn't work. There are those landmark studies, right? The ones that looked at lottery winners and accident victims.
And they confirm it. People consistently return to their happiness baseline over time, no matter what happens. That thrill of the new purchase fades, and it fades fast, which just drives the need for the next big thing.
So people are constantly trading long-term security for these fleeting little pleasures. We have to counteract that impulse. And the sources we looked at suggest the solution isn't just about cutting spending, but redirecting it.
Yes, exactly. And this is a really profound, actionable tip. Shift your spending towards experiences instead of just more material goods.
Okay, what does that look like in practice?
Well, the research is so consistent here. Spending money on things that create lasting memories.
Mm.
Travel, learning a new language, taking a cooking class with a partner, a big family vacation, that provides a far more sustainable and, frankly, appreciating form of happiness than just accumulating more stuff.
I like that distinction. Memories appreciate, possessions depreciate. That's a really strong way to think about it.
It is.
The joy of an experience, like, I don't know, a challenging hike. You revisit that every time you tell the story or look at the pictures. The joy of a new TV is basically over the second you mount it on the wall. Then it just becomes wallpaper.
It's the difference between a temporary excitement and what you could call sustained narrative value. We should be spending on things that build our sense of self and our relationships. Those are way more resistant to hedonic adaptation than just static objects.
Okay, let's dive into a really specific psychological hurdle that it seems to plague high-income people especially, the trap of just one more.
Oh, this is a classic. It's the financial equivalent of constantly moving the goalposts. High-income earners often have this intense financial anxiety because they set these arbitrary targets. If I could just earn $300,000 this year, I'd be set.
But they never are they?
Never. They hit that target, and what do? They immediately look at their colleagues earning $400,000, and the goalposts just shift. They decide they need even more to feel secure, which basically guarantees they'll never be satisfied.
It's a never-ending self-imposed race. So the actionable tip here has to be defining what enough actually looks like for you. If the treadmill keeps moving the finish line, you have to be the one to plant a flag in the ground and say, here, this is it.
You absolutely have to. And this requires setting clear, concrete, and meaningful financial goals, not just chasing some arbitrary income figure.
So instead of, I want to make more money, it's more like,
Maybe enough is achieving a specific monthly passive income number.
yeah.
Or is knowing your kid's college fund is totally full. Or maybe it's knowing you have 10 years of living expenses saved up so you can go start a nonprofit. These are anchors. They align your actions with contentment, not just endless consumerism.
Defining enough is hard, though. So let's get really practical. The sources we review had 4 strong, actionable strategies to actively fight the pull of the treadmill. The first one is about mindset.
Right. Financial gratitude. And look, this isn't just fluffy, feel-good thinking. It's an active psychological countermeasure.
What does that mean, active?
It means regularly, intentionally, acknowledging the financial progress you have made, appreciating the security you already have. Maybe just taking a minute to reflect on where you were 5 years ago. This active acknowledgement helps reset your happiness baseline so you're not constantly comparing your life now to some imaginary upgraded future.
Okay, so that's the mindset piece. The second strategy is more about control. Setting firm hedonic speed limits. I like that term.
It's about building disciplined, mindful rules to stop the spending from spiraling before it even starts.
So you have to install, like, structural defenses against your own brain's tendency to adapt.
Exactly. You set firm, simple rules that get rid of the need for daily decision-making. We're not talking about, agonizing over buying a coffee. We're talking about big systemic limits.
Give me an example. What's a good hedonic speed limit?
A great one is, I will save 50% of every future pay raise. Or another one could be, I will never spend more than 10% of my annual income on a single car.
Ooh, I really like that 50% raise rule. Because you still get a tangible bump in your discretionary income, right? So you feel rewarded, you don't feel deprived. But half of that increase automatically, before you can even get used to it, goes straight toward your future security. You're making the treadmill work for your savings, not against it.
Precisely. The third strategy is a big one. It's about prioritizing your time over just material wealth.
So using money as a tool to get control over your most finite resource.
Yes. And the research here is really robust.
Right.
People who spend money to free up their time, hiring a cleaning service, ordering healthy prepared meals, even paying more for a better, shorter commute, they tend to be significantly happier and less stressed than people who spend the same amount of money on possessions.
So buying a fancy watch might give you a momentary status boost, but buying back, say, 4 hours of your weekend by outsourcing chores, that provides sustained well-being. It reduces the stress that's constantly draining your energy.
You're not just buying time, You're buying peace of mind. You are investing in your future happiness and your present mental bandwidth.
Okay, and the last strategy,
It all ties into purpose. We're calling it investing intentionality.
which means you have to abandon this idea of just accumulating money for its own sake.
Exactly. Instead of just watching the balance go up, you intentionally structure your wealth so it aligns with your deepest values. That could mean earmarking funds for charity, setting up trusts for family, or aggressively pursuing financial independence so you have the freedom to choose your work. Money becomes a purpose-driven tool for fulfillment, not just a scoreboard.
So when you apply all these strategies together, financial planning stops being about just budgeting. It becomes the active psychological antidote to this whole hedonic adaptation problem.
You're building a system where your natural impulse to adapt is constantly directed towards saving and investing, not toward more debt and more lifestyle inflation.
That focus on systems and intentionality, it brings us to a really difficult but essential hurdle. The internal identity shift you need to make all these external rules actually stick.
This is a huge one. And it addresses this common issue of defining our present financial identity based on our past, often flawed, behavior.
What do you mean by that?
We internalize these limiting labels, right?
Yeah.
We think, oh, I'm just a natural spender because we spent all our summer job money as a teenager, or we were bad with credit cards in our 20s.
And that past identity becomes like it's set in stone
Mm.
and it dictates our future failure.
Yes, that's the identity crisis. We ground ourselves in these definitive limiting statements. I am messy. I am always late. Or the big one, I am just bad with money. And these statements, they act like self-fulfilling prophecies. They make it feel impossible to change.
But organizational psychology really challenges that idea, right? That our personality traits are fixed.
It does. Thinkers in this space, like Benjamin Hardy, they argue that we give our past selves way too much authority over our future actions. Your 25-year-old self who got into debt has no more authority over your behavior today than a total stranger.
So you're saying we don't need years of proven success at saving before we can actually claim the identity of a saver.
Absolutely not. And this is the radical insight here. You can change that identity the moment you resolve to save and take concrete action to back up that resolve.
So it's not an earned title, it's a declaration.
It's a declaration.
Right.
That is the precise moment you claim the identity of a saver.
So the declaration itself is the key actionable shift. You state it, you own it, and you start to internalize the identity of your future self, the person who is disciplined and financially secure.
And you have to ground your stake in that better future self. Your actions will then naturally begin to align with that self-image. If you believe I am a saver, you don't buy certain things. You don't make impulsive decisions that contradict that core belief. The whole internal conversation changes from, can I afford this, to does a saver buy this?
That identity shift is incredibly powerful because it gets at the motivation, but it still relies on willpower, which we all know is a finite resource.
It is.
And this is where that surprising insight of the 100% rule comes in, the idea that it's actually easier to do something 100% of the time than 98% of the time.
This concept, it's so powerful because it eliminates decision fatigue. Just think about the mental energy it takes to constantly negotiate with yourself. Should I buy the expensive lunch today? Should I skip the gym because I'm tired? Should I put less into savings this month because I want that new gadget?
That internal back and forth is exhausting. It's where we fail.
It is. So if you say, I'll exercise 98% of the time, you spend every single day deciding if this is the 2% day, which just opens the door to a million excuses. If you commit to 100%, the decision is already made. It's off the table.
But isn't the 100% rule a bit unrealistic for real life? I
Yeah.
mean, what happens when a big, unexpected expense comes up and it forces you to break that commitment, even for a month? How do you recover that identity without just feeling like a total failure?
That is a fantastic and essential distinction. The 100% rule is about structural consistency, not about rigid, brittle perfection.
Okay, break that down.
If a true, unavoidable emergency happens, a medical crisis, a major car repair, you deal with it. But you don't let that one event shatter the identity or the system. A person who is 100% committed to saving still sees themselves as a saver, even if they have to pull money out for an emergency.
So they haven't failed.
No. The system worked exactly as it was supposed to for an emergency. The key is that once the crisis is over, that 100% automated system immediately kicks right back in.
That reframes it as a system event, not a moral failure or an identity failure on my part.
Exactly. There's a great quote from Michael Jordan in the sources. Once I made a decision, I never thought about it again. That conviction simplifies everything. And applied to saving, The core financial decision for most people should be their retirement saving.
Okay, so let's make that super actionable for someone listening.
You declare with 100% conviction, I will save X percent, let's say 10% for the sake of example, of everything I make for the rest of my life. And the key is you lock that decision in instantly by automating it.
The moment you make the decision.
Yes. Sign up for your company's 401k. Set up an automatic transfer to your brokerage account. That single, one-time action removes the need to make that saving decision every 2 weeks when you get paid. The money never even hits your spending account, so you can't be tempted by it.
So that identity shift, I'm a saver, combined with 100% automation. It means you stop relying on your limited willpower and you start relying on a robust, unbending system and a declared identity. You just are a saver.
And you will need that unwavering commitment for the next stage, which, well, it's universally accepted as the hardest part of the entire wealth journey.
Which is what legendary investor Charlie Munger identified as the first major financial hurdle.
We're talking about the brutal first $100,000.
Hey, this is a big one. Charlie Munger, Warren Buffett's longtime business partner, he made this famous observation. The hard part of the process for most people is the first $100,000.
And it's so true. It's not just some arbitrary round number. It is a key psychological and mathematical milestone. Reaching $100,000 in investable assets, it fundamentally alters how you see financial security and how you make your decisions going forward.
It's a symbol, really. It symbolizes true long-term discipline and strategic planning that you've executed over a long period of time.
It really does. And we should contrast that level of security with reality for most people. I mean, the Federal Reserve often reports that something like 40% of Americans would struggle to cover a simple $400 emergency expense without borrowing money or selling something.
$400,
Yeah.
that's staggering.
It is. So having $100,000 or even just $50,000 in the bank, it completely removes that paralyzing fear of minor inconveniences. That's why hitting this threshold is so transformative.
Okay, let's get into the, as you called it, the brutal math of that first decade, the period Munger called the crawl phase. Because this is where the lack of immediate reward makes most people just give up.
Right. So we'll use a very reasonable model. Let's say you're saving $650 per month. That's $7,800 a year. And you're getting a 7% average annual return, which is a pretty common long-term expectation for a diversified portfolio.
Okay, so $650 a month, 7% return. Under that model, how long does it take to hit $100,000?
It takes 9.5 years.
Wow.
9.5 years to reach $100,477. That's almost a full decade of
Wow.
dedicated, consistent effort every single month without fail. And the data that illustrates this crawl, that's where the real psychological battle is.
Okay, so let's break down the role of compound interest during this crawl. What does the balance actually look like in the beginning before the magic really starts?
Well, in year one, you contribute your $7,800 of your own cash. But because your starting principal is so small, you only earn about $546 in returns.
So your own contribution is more than 14 times greater than what the market gave you.
Exactly. The first $100,000 is built almost entirely by your sacrifice, your effort, and your discipline. Compound interest is barely a factor at that point. It's mostly just you saving.
So if someone listening is in, say, year 4 or year 5, they might be feeling really discouraged. They've sacrificed, they saved, they've avoided lifestyle creep, but they're only halfway there. Let's look at year 5.
Okay, by the end of year 5, you will have contributed $39,000 of your own cash. Your total balance might be around $45,000. So that means the market has only given you about $6,000 in total.
A painful ratio of 6.5 to 1, your effort to the market's help.
It feels like pushing a massive boulder up a very steep hill. It stretches your discipline to its absolute limit. But crucially, this is what builds the saving habit that will serve you for the next 40 years.
And the sources really emphasize that this grinding work, this slow build, it's essential. You have to learn how to save when the returns don't feel motivating at all.
You do. But once you hit that $100,000 milestone, the entire dynamic it flips. This is when compound interest finally kicks into overdrive and begins to work harder than you do.
Right.
The breakthrough happens when the growth from your investments starts to consistently be more than your monthly contributions.
That's the pivot point. That is the shift we want listeners to really focus on. When does the engine finally start roaring?
So let's stick with our example. If we look at the period between year 9.5 and year 10.5, so that 1 year, the investor contributes their steady $700 to $800 in cash.
Okay.
But during that same 12-month period, because the principal is now large, they receive approximately $14,833 in accrued interest and gains.
Wait, hold on. Let me just repeat that so it really sinks in. You're putting in $7,800 of your own hard-earned cash, but your money is making almost $15,000 all by itself.
Your investment is now doing almost double the work that you are. That is the eye-opening power of compounding once you have a critical mass of capital.
It's the point of a financial escape velocity. You stop feeling like you're pushing the boulder and you start watching it roll downhill and pick up speed on its own.
It is. The principal is finally large enough that the market's average annual growth is now a really meaningful dollar amount. And the returns start earning their own returns. It's a beautiful thing.
And the long-term implication. It shows why the discipline of that first brutal decade is so worth it. It takes 9.5 years to get the first 100,000. But if you keep the same contribution in return, how quickly does the wealth multiply after that?
It only takes about 24 and a half more years, so 34 years total, to reach $1 million. The time it takes to hit the next 100,000 and the next, it shrinks exponentially. The hardest part, that initial climb, is behind you.
And this math has these huge emotional and professional implications. The $100 K confidence boost. It's a game changer. It affects every decision you make.
It really shifts your decision-making framework from one of scarcity to one of empowerment. When you have that cushion, you know you can cover an unexpected medical bill or a car repair or even a sudden job loss.
Emergencies start to feel like minor inconveniences, not life-altering catastrophes.
Exactly. And think about how this security changes your professional life. For a listener who's thinking about asking for a raise or maybe moving jobs, how does that $100,000 safety net empower them?
You walk into your job differently.
Totally differently. You interact with management without that hint of desperation that comes from knowing you're one paycheck away from disaster. You can negotiate your salary from a place of strength.
Right. If a company won't pay you what you're worth, you have 6 to 12 months of runway to just walk away and find a better opportunity.
You're suddenly more willing to take calculated risks. Maybe switching to a high-potential startup, demanding that pay increase, or even just quitting a toxic work environment.
You're buying professional leverage, and you're buying mental peace. That makes perfect sense. So, Munger also identified the traits of people who get to this milestone faster than average.
He did. He identified 3 core traits. First, they are passionate about being rational. They make decisions based on numbers and long-term consequences, not emotional whims or consumer desires.
Okay.
Second, they are very eager and opportunistic. They see good financial moves and they jump on them, whether it's maximizing a 401k match or taking advantage of a market downturn. And third, this is key, they steadily underspend their income grossly.
That word grossly really stands out. It's powerful. We're not talking about just clipping a few coupons here.
No, we are talking about creating a substantial, permanent, and often, let's be honest, uncomfortable gap between your income and your consumption. It implies a 30, 40, or even 50% savings rate for some high earners, not the average 5 or 10%.
And that concept of grossly underspending, it requires a complete abandonment of conventional financial thinking, which leads us right into the necessary cognitive shifts required to hit Munger's target.
Right. So we need to abandon what the sources we looked at call middle-class thinking.
Okay, what does that mean?
These are the thought patterns. Things like hyperfrugality, only trading your time for money, automatically upgrading your lifestyle, that actually limit wealth building and keep people stuck right on their hedonic treadmill.
So building wealth requires a total shift in philosophy. The first shift is moving from thinking saving to thinking investing, leveraging your money.
Exactly. The old way is a heavy focus on cash savings in these low-return bank accounts, which is basically just slow storage.
And with inflation, it's actually a wealth-losing strategy over time.
It is. So while cash is absolutely necessary for an emergency cushion, the new way, the wealth-building mindset, is all about deploying any extra money immediately into proven investment vehicles that are designed to grow and compound.
So the actionable goal here is to consistently invest 10 to 25% or even more of your income for the long term. You're shifting from being a storer of cash to a deployer of capital.
That's a great way to put it.
All right, shift number 2. This one addresses the other side of the equation. Focusing on earning more versus cutting costs. Uncapped growth.
The default middle-class response to financial stress is always hyperfrugality, right? Trying to cut every possible cost, from the daily coffee to the streaming services.
And that feels good because cutting costs is something you can control immediately. It gives you a sense of agency.
It does. But the problem with frugality is that it has a mathematical limit. You can only cut your budget down to 0 and you still have to eat. But there is no upper limit on how much you can increase your income.
So the wealthy mindset shifts the energy away from cutting the $5 coffee and puts it towards boosting earning power, developing high-income skills, getting better certifications, taking on side hustles, seeking better paying jobs.
Because increasing your income by 20% is just mathematically way more potent than trying to cut your already tight budget by 20%.
It's not even close. Okay, the third critical shift is to think like an owner versus an employee. Asset ownership.
If you define yourself strictly as an employee, you are trading your time for money. And your earning capacity will always be capped by the number of hours you can physically work.
So to build serious multi-generational wealth, you have to find income streams by owning assets that work without your direct hourly input.
This means starting a side business that can scale, or building intellectual property, freelancing in a way that lets you charge for the value you create, not just your time, or, of course, investing in income-generating assets like rental properties or dividend stocks.
And even if you stay employed, you can still think like an owner by seeking out compensation like stock options or profit sharing. You're building equity, not just drawing a salary.
Exactly. Shift number 4 is directly related to what we talked about in the first segment. Prioritize net worth growth versus standard of living. This is the core behavioral fight against lifestyle creep.
The old way is that automatic psychological upgrade. You get a raise, you increase your lifestyle, bigger mortgage, fancier car, better vacations.
The new way is keeping your lifestyle modest, even Spartan, relative to your income, and just plowing the maximum amount of money you can back into your investments. This is the definition of Munger's grossly underspend.
So when a listener gets a big bonus or a 10% raise, the actionable takeaway isn't to start browsing for a new car. It's to maintain their current comfortable lifestyle and dedicate that entire difference, the full 10% or the entire bonus, straight into their investment account.
You are actively accelerating your growth trajectory by widening that gap between what you earn and what you spend.
And the final shift. This might be the biggest psychological hurdle of them all. Thinking abundance versus scarcity. Opening up to opportunity.
Scarcity thinking is the default for so many people, especially if you grew up without a lot of means. It's this deep-seated belief that money and opportunities are inherently limited.
And that leads to avoiding necessary risks, right? Underinvesting in yourself, closing your eyes to new possibilities because you're terrified of losing the little bit of security you have.
Right. The wealth-building mindset, on the other hand, embraces abundance. It recognizes that we live in this expanding global economy with vast opportunities. It means being willing to invest in your own education, to bet on a business idea, to take calculated, measured risks that have a high upside potential.
So an actionable tip here is to consciously surround yourself with successful, optimistic people. Let their growth-oriented attitudes redefine what you think is possible.
Absolutely. These 5 shifts, taken together, they move you from a consumer-based perspective, where money is just something you spend, to an ownership-based perspective, where money is capital that you deploy strategically.
Which brings us to our final and maybe most actionable segment. We're going to focus on the controllable factors that will actually make sure you survive that brutal crawl and hit the $100K threshold. We're talking discipline, rate of saving, and accountability.
We have to start with what is probably the single most surprising and counterintuitive insight for new investors. Early on, your rate of saving, the percentage of your income you set aside, is far more crucial than your rate of return.
Okay, that's a big statement. Most people obsess over which index fund to pick, which stock is going to pop.
Right. Or if they should hire some genius fund manager to try and eke out an extra 1% return. But in the early stages, when your principal is small, chasing that extra 1% is just a distraction. The accelerator that you have full control over is your savings rate.
You control how much money you pour into the pot. You can't control how much the market is going to give you back.
Exactly. So let's use some data to prove just how big the difference is in the long term, because it's astonishing. Let's look at 2 people, both earning $100,000 a year, both getting a steady 7% return over 30 years.
Okay, same income, same return.
Person A saves a good but pretty standard 5% of their income. That's $5,000 a year. After 30 years, they end up with roughly $650,000, which is a respectable retirement fund.
Not bad. Now, person B, this is the person who took Munger's advice and committed to grossly underspending. They only doubled their savings rate to 10% of their income, so $10,000 a year.
After those same 30 years, person B has roughly $1,300,000.
Wow, $1.3 million.
Doubling the savings rate effectively doubled the final outcome. That difference, $650,000, is enough to pay off a house early, or fund a decade of private school for 2 kids, or just provide a completely different level of financial freedom.
The lesson is absolutely crystal clear. You get infinitely further by figuring out how to save an extra $500 or $1,000 a month than you do by trying to find an investment that might yield an extra 1% return.
It's not even a contest in the early years, so we need concrete behavioral strategies for disciplined saving.
The first one is implementing zero-based budgeting.
This method forces you to give every single dollar you earn a purpose, which systematically cuts down on unnecessary spending. You have to treat your savings not as what's left over at the end of the month, but as just another bill that has to be paid. You pay yourself first.
The second strategy, and this ties right back to our 100% rule identity shift, is to automate savings.
You have to get a disciplined head start. Automate a fixed percentage of your income directly into your investment vehicle. And critically, set rules to save a percentage of all that extra money you get, bonuses, tax refunds, any unexpected windfalls, before you spend a single dime of it.
There's another great tactical trick for people who get paid biweekly. You can use those 2 months a year where you get a third paycheck.
That's a fantastic one. If you build your monthly budget around the standard 2 paychecks, that third paycheck, which shows up twice a year, is pure surplus. Use that entire check to fund a major savings goal. You can really accelerate your climb to that $100,000 mark without feeling any lifestyle strain at all.
And wrapping all of these strategies together is that core commitment to just living below your means.
It's a conscious choice, choosing needs over wants, embracing a form of minimalism, maintaining a steady lifestyle even as your income grows, and just funneling that entire difference directly into savings and investments.
And finally, we have to acknowledge that no big goal is achieved in a vacuum. You need a support network. This is the accountability engine.
You really do. You need to find a partner who shares your financial goals and values. This could be a trusted friend, a family member, or a professional financial planner. Someone who can keep you honest when you feel that psychological pull of the hedonic treadmill demanding an upgrade.
And you need regular, structured check-ins. Bi-weekly, monthly, whatever works.
Yes, those meetings are crucial for tracking your progress toward that Munger threshold, for celebrating the small wins, and for troubleshooting any hurdles you run into. That structured tracking makes sure your long-term rational goals don't get lost in the day-to-day noise.
And while having a friend is invaluable, working with a financial planner can add that professional insight, guidance on the right investments, and an objective third party to hold you accountable. That combination of peer and professional support creates a really robust framework for success.
Before we wrap up, I just want to explore one final psychological layer that many successful wealth builders seem to use. It's what some call the paradox of generosity.
Interesting. How does that connect back to escaping the treadmill?
Well, for some, the act of consistent generosity, whether that's through tithing or charity, it isn't seen as a financial burden. It's actually an affirmation of their trust in abundance and provision.
It breaks that scarcity mindset we talked about.
It shatters it. When you are constantly giving away a portion of your wealth, you are mentally affirming that you have enough and that there will always be more opportunity out there. This practice fosters a kind of internal peace and stability, which are far more resistant to the hedonic treadmill than chasing satisfaction through just buying more stuff. It reinforces the idea that money is a tool for meaningful impact, not just for personal accumulation.
That really brings us full circle. We started by talking about the psychological treadmill that destroys wealth, and we're ending with the strategies to intentionally step off of it.
Wealth is built not just by accumulating more money, but by using it intentionally, through those mindset shifts, that unwavering savings discipline, and breaking free from that deep psychological need to constantly upgrade your standard of living.
Hedonic adaptation means the joy from new purchases fades fast.
It always does. The only way to get lasting, sustainable satisfaction from your money is to use it to buy financial security and time, the very stability you gain from the discipline it takes to save that first $100,000. Once you hit that milestone, you've successfully leveraged your own psychological adaptability against itself. You've won.
We've established that your rate of saving is overwhelmingly more important than your rate of return for the majority of your career. So here's a final thought. If you could cut years off your goal timeline by increasing your savings rate by just 5% starting today, which means delaying the achievement of that $100,000 security milestone by years, what immediate lifestyle upgrade would you happily delay to get those years back? That choice. That is the difference between running on the treadmill and walking towards financial freedom.